Imagine finding a company, right? Trading at a steep discount, uh, boasts a fortress balance sheet, management team really invested, like skin in the game. But then you see analysts predicting future earnings declines. So is this a hidden gem just waiting? Or is it, a cleverly disguised value trap? Today, we're diving deep into Innovex International. We're going to try and figure that out.
Yeah, it's a fascinating puzzle. Analyzing a company like this, newly formed, especially through really aggressive M&A, it means peeling back a lot of layers. You have to really dig in to see the long-term potential. We're going beyond just the surface stuff today.
Welcome, everyone, to another deep dive. Today, we're taking a really comprehensive look at Innovex International, Inc. That's ticker symbol INVX, currently trading around $16.17. Our sources for this deep dive, they come from a detailed stock research protocol, and it's all designed to answer one central question. Can Innovex International, this newly forged entity, can it successfully integrate all these different parts? Can it create a durable, high-return industrial platform, one that can actually thrive through the inherent ups and downs of the energy cycle?
Exactly. In this deep dive, it's designed to give you, the listener, a shortcut. You get to be well-informed, get those crucial insights that you might miss just reading headlines. We'll look at not just what they do, but importantly, why it matters for investors.
Absolutely. So today's deep dive is split into two main parts. In this first part, we'll tackle the company's core business, we'll evaluate the leadership, and really dissect its financial health. Then, in the second part, we'll get into market sentiment, ownership structure, and those critical risks you need to know about. Okay, with that set up, let's jump right in. First up, Chapter 1, Business Analysis. So, like we just mentioned, the big question here, can INVX integrate these acquisitions, build that durable platform, especially in this very cyclical energy market? Our analysis date is August 17th, 2025, stock price $16.17.
Right. So Innovex International, officially born in 2024, came from merging Dril-Quip Inc. and Innovex Downhole Solutions. Their basic business model is designing, manufacturing, selling, and renting these mission-critical engineered products. It's all for the global upstream oil and gas industry. Think of them as the guys providing the specialized tools, the components that will make drilling and production actually happen.
And what seems really interesting is how they've diversified their revenue. Three main streams. In Q1 2025 alone, products brought in $167.4 million, services about $35.1 million, and rentals $38.0 million. How significant is that spread, especially in a sector that's known for being so volatile? Does it really give them some protection?
Oh, it's hugely significant. It's not just, a list of numbers. It's a real insight into how they've spread their bets.
Yeah.
In an industry like oil and gas, that diversification acts like a shock absorber. It means they're not totally reliant on one single volatile income source. And that's really key when we're asking if they can build something durable.
Okay, that makes sense. And their portfolio, it sounds pretty extensive, covers the whole well life cycle, from the start, construction, all the way to production.
That's right. And they have some specific proprietary technologies, too. Things like Dril-Quip subsea wellheads, WearSox deepwater centralization products, SwivelMASTER deployment tech. These act as key differentiators for them.
They're global too, right? Based in Houston, but North America is what, 55% of revenue? And international offshore, the other 45%. And I saw they recently bought Citadel Casing Solutions to boost their U.S. land position.
Correct, on both counts. That Citadel acquisition really shores up their presence in the important U.S. land market. It shows a strategic focus there.
And their value proposition, it's pretty clear. Drive efficiency, lower costs, reduce rig site footprint. They also talk about this big impact small ticket idea. Basically, their critical products make a big difference to well performance, but they're only a small part of the total well cost. That sounds like a really strong selling point. Customers must love that.
Absolutely. Now, the industry itself, it's undeniably highly cyclical. Oil and gas fueled machinery and equipment. It's tied directly to what energy producers decide to spend on capital projects. But interestingly, management explicitly says their strategy is to use the cycle to drive growth. That's not just talk. It really points to their counter-cyclical M&A approach. They see downturns as buying opportunities. That's quite different.
Okay, but here's where it gets tricky, and it's kind of the core tension we mentioned. Analysts forecast 8.3% annual revenue growth, but they also predict a decline in earnings per share. That's concerning. It signals maybe margin pressure, or maybe challenges integrating everything. Raises that whole value trap question again.
And the competitive landscape is fragmented. You've got the big players like Weatherford International, that's WFRD, and more specialized ones like Cactus, Inc., WHD, Innovex, with about a $1.11 billion market cap, sits as a significant mid-cap player. Also worth noting, they stick to strict regulatory standards, operational certifications, ISO standards and such. Shows a commitment to quality.
And getting into this industry isn't easy, right? Huge barriers. You need serious cash for manufacturing, R&D.
Dumped customer relationships, a global service network, protected IP, yeah. All of that makes it tough for newcomers, which, helps establish players like Innovex.
Okay, so what about their competitive advantage, their moat?
Well, it's multifaceted, built on the reputations of the companies they merged, Dril-Quip and Innovex Downhole Solutions. They're leveraging decades of trust, really.
And their key strategy seems to be creating this integrated platform, not just selling individual products. Focus on seamless operations, less complexity for customers.
Exactly. That creates stickiness. Implicit switching costs. If they make the customer's life easier, the customer is less likely to leave. It's a powerful advantage.
They're also looking at costs, right? Supply chain, selling off assets like that Dril-Quip campus.
Yeah, optimizing the supply chain, strategic divestitures, and efficiency-focused acquisitions like SCF Machining in Vietnam, all aimed at being leaner, more profitable.
And this comprehensive portfolio they've built through M&A, combined with a capital-light model. CapEx only 2–3% of revenue.
Right. That capital-light approach is crucial. It means strong free cash flow, potentially high returns on capital, and it's fundamental to their ability to use the cycle to drive growth. It directly addresses our core question about thriving through volatility.
So that enables this counter-cyclical M&A strategy, buying when others might be struggling.
Precisely. Acquiring complementary assets at good prices during market stress. That Citadel acquisition, done when oil prices were falling, is a perfect example. That kind of proactive move in a downturn is a key indicator, potentially, of a value opportunity.
Okay, we've dug into the business itself, the strategy, the competitive landscape. But a strategy is only as good as the team executing it. Let's move on. Chapter 2, Management Evaluation.
The leadership team here seems really well suited for this growth through acquisition strategy. You have CEO Adam Anderson, led legacy Innovex since 2016, background in petroleum engineering, and an MBA, plus experience at Baker Hughes. And CFO Kendall Reed, also since 2016, came from VP Corporate Development, strong background in private equity M&A. That combination, industry knowledge plus M&A expertise, seems like a good fit for what they're trying to do.
And their recent track record seems pretty active. Successful merger with Dril-Quip, then these acquisitions, DWS, SCF Machining, Citadel.
They've definitely been busy. And so far, it looks like they're executing that vision. Plus, they've shown resilience. Q2 2025, they miss on revenue, but they stuck to their down cycle playbook, maintained profitability, grew free cash flow, closed that Citadel deal. That shows discipline, even when market conditions aren't ideal.
They do standard investor comms, have a formal code of business conduct. But there was that interesting incident in 2020. CEO Adam Anderson called out the North Face for not wanting to co-brand jackets, called it counterproductive virtue signaling. What do you make of that? It seems like it shows leadership willing to, well, defend their industry.
It absolutely does. It suggests a management team that's not afraid to stand up for their industry, for their employees, even against public perception sometimes. That kind of conviction can actually be quite reassuring for investors. Shows a clear sense of identity.
Okay, let's talk capital allocation. Seems like two clear pillars, M&A and shareholder returns.
Yes, very clear. The M&A framework targets highly accretive deals, ones that fit that big impact, small ticket idea. Citadel is the prime example, $70 million, all cash. Bought at roughly 3.8 times its last 12 months adjusted EBITDA. That's a common metric. And 3.8x suggests, a potentially very good price.
And the fact that both the CEO and CFO have these strong M&A backgrounds, it really suggests they'll keep executing on this front. Lends credibility.
Definitely. And then there's the shift toward shareholder returns. No dividend, but they started a big $100 million share repurchase program in early 2025. And they're actively doing it. Bought back over 624,000 shares, average price around $14.89 by the end of June 2025.
Right. And the CFO called the buybacks a competing use of capital. That sounds like a strong signal, doesn't it? Management thinks the stock is undervalued.
It's a very strong signal. It says management believes their own shares are a compelling investment at current prices. For you, the listener, that's often seen as a bullish sign. They're betting on themselves.
What about return metrics? ROIC, ROCE.
Their normalized return on invested capital, ROIC, is running between about 8.2% and 11.5%. And return on capital employed, ROCE, actually improved. Went from 12% in December 2024 up to 13% by June 2025. They have a long-term target of 18%, so it shows they're moving in the right direction in terms of using capital efficiently.
So taking all that and the disciplined capital use, the strong insider conviction, what does that suggest about where the company's headed? Does this point towards value opportunity?
I think it really does. That high level of insider conviction, backing it up with a clear strategy focused on accretive M&A and share buybacks. It strongly suggests management believes the market isn't fully appreciating their long-term potential. They're putting their money where their mouth is. That's usually a positive sign.
Okay, good context. That brings us neatly to the numbers themselves. Let's dig into Chapter 3, financial analysis.
All right, so as of our analysis date, market cap around $1.11 billion.
Yeah.
Mid-cap player. And it's really crucial to remember their 5-year financials show a company that's fundamentally changed because of that 2024 merger. Anything before 2024 is legacy Dril-Quip. After that, it's the much larger combined Innovex International.
And that change is obvious in the revenue numbers, right? Legacy Dril-Quip had some declines, but the combined companies show strong growth. $467 million in 2022, up to $661 million in 2024. That's pretty solid.
Profitability looks transformed too. Trailing 12 months, gross margin nearly 33%, operating margin over 11%, net profit margin almost 17%. Those are pretty healthy margins for this sector. Reflects some of the benefits of integration probably.
And the free cash flow story is, well, pretty dramatic. Legacy company was negative FCF back in 2020, but then $79.8 million generated in 2024, and an impressive $76 million just in the first half of 2025 alone. That really highlights that capital-light, cash-generative model that's often a characteristic of these potential hidden gems.
And their balance sheet. You could genuinely call it a fortress balance sheet. Only about $41 million in total debt, against almost $1 billion in stockholders' equity. That gives them an exceptionally low debt-to-equity ratio, around 0.04. Very little leverage.
Liquidity looks strong, too. Current ratio of 4.60. That suggests plenty of flexibility, right?
Absolutely. Very stable financially. However, earnings have been volatile. That's partly the industry cycle, partly the transformation they're going through. And while the combined Innovex has been consistently profitable, remember those analyst forecasts predicting a future decline in earnings. That creates this central tension. Is it a temporary dip or something more serious? Especially since they're using cash for M&A and buybacks, not dividends.
Okay, so valuation. This seems key. You said it looks significantly undervalued on a relative basis. Trailing PE between 5.6 and 7.75.
Yes, compared to the broader market average around 28.7, or even the energy sector average around 73, that PE looks very low.
Which brings us back to that classic dilemma.
Exactly. Is it a value trap, priced low because fundamentals are expected to worsen? Or a value opportunity where the market is just underestimating the long-term earnings power and synergy benefits? Management's aggressive buybacks clearly signal they believe it's the latter.
And comparing them to peers like Weatherford and Cactus, their PE really stands out as low.
It does. It makes the valuation look even more compelling on a relative basis.
So what about intrinsic value? Did the research protocol include a DCF model?
Yes, an educational discounted cash flow model was used. And based on that model, the estimated intrinsic value range for INVX comes out between $19.50 and $24 per share.
Okay, $19.50 to $24. What were the key assumptions behind that? You mentioned conservative ones.
Right, pretty conservative.
Right.
We used a 5-year revenue growth rate of 7.0%. That's actually slightly below the analyst consensus, just to build in a buffer for that cyclicality and integration risk. Terminal growth rate assumed at 2.0%, sort of a long-term inflation measure. Free cash flow as a percentage of revenue stabilizing at 10.0%, reflecting that capital-light model. And because of their strong balance sheet, very little debt, their weighted average cost of capital, or WACC, comes out relatively low at 9.5%. That reflects a lower risk profile.
Okay, so we've covered the business, the management, the financials. That DCF gives us a value range to think about. Let's unpack this further now. See what the broader market is thinking and start pulling towards a conclusion. We're moving into Chapter 4, market sentiment.
Right, and the market's view on Innovex seems deeply divided. You look at the consensus analyst rating, it's a buy. The average brokerage recommendation, ABR, is 2.00, lower numbers are better. But that masks a really wide range of one-year price targets, from a low of $13 all the way up to $22.05. That's a huge spread.
Wow, $13 to over $22. That's a massive difference in opinion. You've got Piper Sandler at overweight with a $20 target, and then Barclays at underweight with just $13. It really sounds like Wall Street is struggling to get a handle on this newly merged company. Bulls see synergy, bears see risk.
That's exactly it. Bulls are focused on the potential integration benefits, the platform strategy. Bears are worried about execution risk, potential margin pressure, and those cyclical headwinds. It perfectly highlights that hidden gem or value trap debate.
What about recent news, mostly focused on strategy execution, Citadel asset sales?
Yeah, recent company news has been mainly about them doing what they said they'd do. Positive communications highlighting market share gains, strong free cash flow. Though if you look back a bit earlier in 2025, there were some cautious media headlines questioning earnings quality. So that underlying tension has been there.
Okay, now, interestingly, you mentioned the technical indicators paint a more bullish picture. That conflicts with the mixed fundamentals.
It does. It's like the charts are telling one story and the income statement forecasts are hinting at another.
What about short interest?
Short interest is at 2.9 million shares. That's about 7.69% of the float. It's moderately elevated, sure, but it's not extremely high. Usually over 10% is where you see major red flags for intense bearish bets. So elevated, but maybe not critical.
And the stock price itself, $16.17, trading above its moving averages.
Yes, it's just above its 50-day moving average, around $16.11, and more comfortably above its 200-day moving average, which is near $15.90. Trading above the 200-day is often seen as a classic long-term bullish signal by technical analysts. Suggests underlying upward momentum.
And there was a golden cross recently.
That's right, August 6th, 2025. The 50-day moving average crossed above the 200-day moving average. Technicians often interpret that as confirmation of a long-term uptrend starting or strengthening. It's basically the chart saying, hey, the longer trend looks positive.
So how do you square that? Bullish technicals, but this murky fundamental picture with declining earnings forecasts. What does that divergence really tell us about market perception right now?
It suggests, that maybe momentum traders are influencing the price action. They're buying based on the technical signals, the uptrend. While perhaps the more fundamental value-oriented investors are still cautious, they're waiting for clearer proof that earnings will stabilize or that those synergies will really materialize. It's a bit of a tug of war.
Fascinating. A real split. Okay, let's look at who actually owns the stock. That can tell us a lot, too. Moving on to Chapter 5, ownership structure.
This is a really defining feature for Innovex. The ownership structure is quite striking. You have 409 institutional owners. Together, they hold over 51 million shares. Big names like Brandis Investment Partners, BlackRock, Vanguard. They hold substantial stakes. Although, recent institutional buying and selling has been a bit mixed. No strong consensus there either.
But the most striking part is the insider ownership, right? Reported at 43.90%. That seems incredibly high.
It is exceptionally high. Nearly half the company owned by insiders, management, and potentially board members. That level of skin in the game, as you called it earlier, is pretty unusual for a public company this size. It creates a really powerful alignment of interest between management and the outside shareholders. Their personal wealth is directly tied to how the stock performs, and that lends huge credibility to decisions like that $100 million buyback. They're not just spending company money. They're effectively buying alongside other shareholders, betting on themselves.
And crucially, you mentioned recent insider transactions. Mostly non-open market stuff like compensation, but no open market sales by insiders in the last 3 months.
Correct. No insiders heading for the exits, selling shares on the open market recently. That definitely reinforces the sense of internal confidence. Suggests they don't think the current price is too high. Maybe they think it's too low.
Wow. So that level of insider ownership is really something. For you, the listener, how does that change your view? Does that make you lean more towards the value opportunity side, knowing management is so heavily invested themselves?
It's a powerful factor to consider, definitely.
Okay, we've covered a lot of ground, looked at the good and the uncertain, but no deep dive is complete without really facing the potential downsides. Let's tackle Chapter 6, risk assessment.
Right, a SWOT analysis helps frame this. Strengths are clear, that comprehensive integrated portfolio, the capital light model generating strong free cash flow, the fortress balance sheet, experienced M&A management, and that huge insider ownership.
Okay, weaknesses. Obviously, the risks tied to that M&A strategy itself. Integrating lots of companies is hard. Potential for margin pressure, at least temporarily. Also, that recent revenue miss, the negative earnings forecast. Those point to operational headwinds, execution risk. These feed the value track narrative.
Opportunities exist too. They could leverage the platform to expand internationally, cross-sell technologies from acquisitions like Citadel and DWS. There's potential for more margin expansion from low-cost manufacturing in Vietnam, continuing that down-cycle playbook for M&A.
Yeah.
And the buyback program itself is an opportunity to create shareholder value.
And the threats. The big ones seem to be the inherent cyclicality of oil and gas and just intense competition. Those are always there.
Beyond the industry cycle, though, a broad macroeconomic slowdown is a major threat. If global energy demand drops, drilling activity slows, and that hits Innovex's customers hard.
And there's that specific immediate threat you mentioned earlier, the 2025 U.S. tariffs on imported steel, aluminum, other capital goods. This isn't minor.
No, it could have a multifaceted impact. It could increase their own raw material costs for manufacturing. It could also raise overall project costs for their customers, which might lead to delays, cancellations, reduced demand for Innovex's products and services. Plus, with 45% of their revenue coming from outside the U.S., there's the risk of retaliatory tariffs hitting their international sales.
So that geopolitical risk, the tariffs, it's material. It could potentially undermine the margin expansion and cost synergies that are really key to the whole investment case here. This raises a crucial question for you, the listener. How do you weigh these significant external threats against the company's internal strengths and opportunities? Are the risks big enough to make it a trap? Or are the strengths compelling enough to make it a gem despite the risks?
It's the core dilemma.
Okay, that brings us to wrapping it all up. Let's move to our final synthesis, Chapter 7, Conclusion.
So to pull it all together, the investment case for Innovex International really embodies that classic conflict we've been discussing. Deep value metrics on one side, significant near-term risks on the other. Hidden gem versus value trap, plain and simple.
Let's lay out the bull case again. Compelling valuation trading at a big discount. Robust balance sheet, very little debt, capital-light model churning out significant free cash flow, and a highly aligned management team that's executing clear M&A and capital return strategies. Bulls believe the market is simply undervaluing the long-term earnings power and synergy potential here.
Then the bear case.
Yeah.
That consensus analyst forecast of declining future earnings is a big red flag, suggests value trap. There's significant execution risk integrating all those acquisitions, potential for margin pressure, and exposure to powerful cyclical headwinds, plus those geopolitical risks, especially the 2025 tariffs.
And our educational discounted cash flow analysis, using those conservative assumptions, gave us an intrinsic value range for INVX of $19.50 to $24 per share.
Right. So as of August 17, 2025, the share price of $16.17 is trading at a significant discount to even the low end of that estimated intrinsic value range.
Which suggests maybe the market is being overly pessimistic here, focusing too much on the near-term headwinds, the integration risks, and maybe undervaluing the long-term cash flow potential, the platform they're building, and the track record of this very aligned management team. So, knowing all this, what stands out most to you? Does Innovex International look like a genuine value opportunity waiting to be recognized? Or are the market's fears about future earnings and those external risks completely justified?
And perhaps what other information might you want to find? What further research might you do to really solidify your own view before making any kind of decision?
And that wraps up our deep dive into Innovex International. We really hope this exploration has given you a much clearer picture of this very complex and fascinating company. If you found this deep dive valuable, please remember to like and subscribe to Stock Analytics AI. It really helps us out. For just $4.99 a month, members get priority deep dives on tickers just like this one. And over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives. Or if you just want a one-off deep dive on a specific stock, drop us a super thanks.
And just a quick but very important note, this analysis was generated by an AI system. It's purely for educational purposes only. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Knowledge is most valuable when it's properly understood and applied.
Thank you so much for joining us on this deep dive. We look forward to exploring more fascinating topics with you next time.